The S&P 500 made another all-time high last week, so why does it feel like we're standing on shaky ground? Well, for one, the VIX spiked to 19. You guys heard it on this channel. I told you that for this year, it seems that the base of the VIX is around that 14-15 range, and you can buy at the money calls that expire in a couple of weeks to hedge your portfolio on a week-to-week basis. But why does it feel like we're on shaky ground? What is going on here beneath the surface? In this video, I'll give you my current market update based on all the information that we know now. Your fears are not unfounded, by the way. Unfortunately, I don't think volatility is out of the way for next week as we have a ton of events coming up. So I will be telling you what to watch out for exactly next week. And then I'm going to run through some stocks and some opportunities here on companies like Tesla, Nvidia, AMD, SMCI, so on and so forth. Let's get right into it. Everything is timestamped below for your convenience because I respect your time. So as I was saying at the outset, just on Wednesday, February 19th, last week, as at the time of this recording, the S&P 500 recorded an all-time high close. And that was right after it recorded an all-time high close just the day before. So two all-time high closes back to back. Why does it feel like the market is on shaky ground? Well, because on Friday we had an almost 2% drop in the S&P 500, which is not typical. And so far this year, we have seen a few 2% or more drops in the S&P 500 and or the NASDAQ. So it doesn't quite feel like a normal, healthy market to us. Plus, we've had back-to-back years of plus 20%. So there's this overarching narrative that maybe things are overvalued, maybe AI is a bubble, maybe this is a ticking time bomb. But I have some news for you. This is how traders and investors, especially retail, feel every single time the market drops to a pullback or even a correction. I've been around the markets a very long time and this happens without fail. However, I will remind you that the S&P 500 averages a bear market only once every 4 to 7 years. However, every time the market drops like this, everyone thinks this is the start of a bear market. But I totally relate to you. Your feelings this time are not unfounded because we continue to have VIX spike after VIX spike. This is the volatility index. In the beginning of January, we had a VIX spike to 19, then we had another VIX spike to 22, then another one to almost 23, then another one to almost 21, and then this past Friday, as of the time of this recording, we had one to 19. Now, the reasons for this are probably not unfamiliar to you, but first of all, the Trump tariffs. We've seen the mayhem that it caused in 2018. That was one of the most volatile markets I've ever seen, although the end result wasn't so bad, but it was just so wavy in this range. So if we take a look at 2018 here, you can see that the net result, if you look on the top right, was only minus 6.24% for the year. So not a terrible year, but it felt like a roller coaster to get to that minus 6%. So to kick off 2018, we had about a 10% correction to start the year. Then from there until October, we had about a 15% monster rally. And then from there to round out the year, we had an almost 20% drop. It was actually 19.8% if you measure it accurately, just saving a bear market. And then 2019, we recovered like a champ. So this type of volatility, all of this resulted in a minus 6.6% year. But when you were in it, it felt like we're in a bear market, no, a bull market, no, a bear market. It was definitely very volatile. Second thing is the data is really not satisfying the Fed right now. We've been told that we're on a smooth path to 2% inflation, that everything's going well. Even when we've had a month or two of hot data, we've been told that this is transitory, but you can see this is not a good trend. We bottomed out in September at 2.4% year over year inflation, and we have gone up ever since to now recording finally again a 3% inflation rate for the first time since June of 2024. This is not trending the right way. Then the obvious uncertainty with the Fed funds rate. The Fed pumped rates at the fastest rate ever to 5.25%. And then in September of 2024, they started cutting. And ever since they started cutting, which was here, the 10-year actually started rising as opposed to going the other way. For the first time ever, 100 days after the cut, the 10-year is actually higher rather than lower than when it was when they first started cutting. Now, more on the 10-year in a second, because I actually think that bond yields are going to start dropping, which is why I'm going to be increasing my bond position. I started investing in bonds towards the end of last year, and now I'm looking to increase my position. More on that later. Now, a couple more reasons why it feels shaky. If you look at the risk on stocks like Palantir, stocks like HIMS, it seems like the market doesn't have an appetite for these stocks in the short term. Obviously, to me, some of these are just pullbacks and corrections because they have been so parabolic. Nobody asks why these stocks run up hundreds, sometimes thousands of percentage points, but the minute they correct once, people start running around with their heads cut off. And then lastly, if you look at the Mag 7, if you look at Amazon, if you look at Microsoft, if you look at Google, if you look at Nvidia, if you look at Tesla, these stocks have not done well to start the year. Now, this to me is actually a good sign, not a bad sign. This is a good sign of breadth, meaning that the market isn't relying in 2025 on the Mag 7. We hit all-time highs, back-to-back all-time high closes without the Mag 7. This is what you want. So where do I think the market is going from here? As I said, it's going to be a volatile 2025. And I don't have a super high price target for this year anyway. I had 6,300 as my price target at some point this year, but I'm not as worried with the price target as I am about the structure of the market. So as long as we're above the 100-day moving average, which is this yellow line, we are good. However, a healthy market doesn't tend to revisit the 100-day moving average time after time after time again in a healthy market. In a bull market, you will typically hit this 2 to 3 times a year, but not really that much. Secondly, we have Nvidia earnings coming up on Wednesday. Now, this is going to be huge because it is going to tell us whether the market will perceive that AI is in a current bubble or not. What we want to hear is whether Nvidia's guidance is showing that there is going to be a reduction in spending on AI and on AI infrastructure. And right now there's this super annoying news story supposedly that's coming out saying that Microsoft is canceling its data center leases, which means that it's cutting back on spending. This right now is making the rounds on social media. You might have already seen it, but one, it's already recycled news. Two, the number of data centers and the amount of megawattage pales in comparison to what Microsoft said that it would spend already. And three, it doesn't give a reasoning for the lease cancellations. Most of the time when these big corporations cancel data center leases, it's because the vendor, they don't believe the vendor can deliver or the vendor isn't delivering. This also may have something to do with OpenAI and the fact that Microsoft may be reducing its partnership with OpenAI or the other way around. This isn't really an indication of Microsoft reducing its capex from what they stated in the last earnings. Either way, if Nvidia reports negative earnings, which I doubt, but if they report reduced guidance, significantly reduced guidance, then I think that can be the catalyst that will cause an immediate market correction in the first quarter of 2025. And lastly, just on the stock market, there can be seasonality in February. Mid-February is typically when, going all the way back to 1950, you can see that mid-February is one of the worst performing short time windows for the S&P 500. This doesn't mean that the rest of the year is bad. This just means that usually the second half of February is kind of a lull. This is when all earnings have already been reported, when all of the enthusiasm from the holidays, and in this case, the holidays plus the election, all that enthusiasm is over, and there isn't really anything to look forward to until the year starts kicking off, people start spending money again, companies start spending money again. We get more data, we get potentially more hiring, but I will be very curious to see how February ends. Does it end green? Because man, the data for January and February both being green, look at the times that this ends in a green market. 93% of the time, this means that the year ends green. 96.5% of the time, it means a full calendar year. So February 2026, from now until then, is green. The stock market is amazing, man. It's the best way to make money. So in summary, I do think we will still see a ton of volatility. I don't see a lot of catalysts for the market to continue rallying like it did the last 2 years. I definitely don't see more upside than downside for this year. And I think a negative guidance on Nvidia can cause the first casualty of war in the stock market correction battle of 2025. All right, on to the stocks. Tesla, let's start with that and then we'll jump to the others. But Tesla right now is sitting at the 100-day moving average. As I said, Q1, Q2 seasonality on Tesla is utter crap. You can test this out going back to 2024, 23, 22. It typically suffers a lot and very uglily, is that even a word? Hideously, let's just say that. It suffers in Q1 and Q2 of 2025. I would not be surprised once again if Tesla dropped to 270, to this range where we have resistance, 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 support, gap, and the 200-day moving average. This would be a fabulous confluence here. I would be definitely a buyer at this level if we get there. I'm not long, I'm not short on Tesla. I have shares obviously that I continue to buy at major dips, but I don't have any options play here, and I personally would not open an options play here unless you wanted to sell the 270 cash secured puts and potentially get assigned if it hits that, or make money from the premium if it doesn't hit that. So if we go to our trusty public account here and we go to a month expiration from the time of this recording, let's say you go to March 28th expiration, you can now, because of the implied volatility, you could sell the 270 puts for $244. So if Tesla is 270 on March 28th, then you get assigned 100 shares of Tesla at 270 minus 244. So that's 267.56, I believe, if my math is correct, which is great. If Tesla isn't 270 by March 28th, then you get to keep the $244. And the awesome thing about public is you do earn 1% annualized on cash secured puts, and you also get rebates for every options trade that you make. So not only are options trades commission free, but you also get a rebate. I've been using public all this year. It is my preferred options trading and investing platform. It is regulated based here in the US. And for more on public, and I'm sure you guys may have noticed, but I switched over to using public for my investing as well as my option swing trades and selling cash secured puts. It's a regulated broker based here in the US. Now, the reason that I like it over other trading and investing apps is because not only are the options trades commission free, there are no commissions or no contract fees for options trades, but you also get a rebate for stock and ETF options trades. The rebate means that options trades are not only free, but you also earn money. They are less than zero. Now, the rebate is based on your monthly trading volume, so the more you trade, the higher your rebate is per trade. And for any cash that I'm not using, I could just throw it into a high yield cash account that they have and earn 4.1% on my money. Now, Nvidia is at a major inflection point. We longed Nvidia, and I gave you guys that idea in my previous video. You can see here on the trading and investing floor, February 12th, I said Nvidia is retesting a major level after breaking out off of a 200 moving average retest right here, going to buy the 130 calls expiring March 7th. Ended up closing those Nvidia calls. As you can see here, I give you all of my plays in real time, closed it for 70%. Now, all that was coming off of the 200-day moving average, where I also bought shares, by the way, but we broke above this major resistance, this line here, this yellow line, came back to retest it, just a simple break and retest of this major level that meant a lot to me and to Nvidia. And I just wanted to ride it until it filled the gap, because if you notice, Nvidia always fills its gaps. Now, that level was resistance here, resistance, support, 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 resistance. You can see why it's a major level. So right now, before earnings, we are retesting the 50 and the 100-day moving average. If we see how Nvidia performs during earnings, it's actually quite surprising. Nvidia often misses the expected move. So you can see here, the options market overestimated Nvidia stock earnings move 67% of the time. So it often misses the expected move. This is a good thing, because if you wanted to get into Nvidia, you can actually wait and see what the earnings are before jumping in, because most of the time it actually doesn't move after earnings. I would not buy calls or puts here, guys. Don't be a freaking hero. Not before earnings. Wait until the IV crush happens and then set up your play. If I had to guess just based on this technical setup, this to me looks like a long, but I'm not longing here because of earnings, and earnings can absolutely crush your calls, even if you're somewhat right. But you have the fair value gap here. You have the 50 and 100-day moving average here. You have these equal highs at around 153. You have a break, retest. It's only logical to me that this would be a long if earnings weren't here. So one other thing you can do if you wanted to play earnings is, because it misses the expected move most of the time, you could sell an iron condor to take advantage of that theta decay. Now, I personally would wait until the morning of Nvidia earnings, but essentially you want to sell the 25 delta iron condor. So this would be around, if we're going off current prices, it would be what? The 146. Yeah, you can see here, that's 25 delta. So I would sell the 146 call, buy the 147 call, and then we go to the put side and I would sell the 25 delta. So that would be around the 126 put, and I would buy the one below that, the 125 put, and there you have your iron condor. Again, I'm not going to do this now, but if we were going off of today's prices, you could sell this for $40 and the max loss would be $60 and the max gain would be 40, right? Because you're selling it for 40, you're hoping that theta decay, you're hoping that Nvidia doesn't move either below 126 or above 146, and you get to pocket the entirety of this credit. If Nvidia is above 147 or below 125 on the expiration date of February 28th, then you are going to lose a maximum of $60 per contract. So it's awesome because there are $1 wide strikes on Nvidia. It's not a very expensive option. And that's likely what I would do, but I'm not going to open it now. I will wait until the day of earnings. But do not buy calls and puts, guys. You are going to give your money to the market and they will treat you like a dum-dum. All right, AMD. I also gave you an AMD short idea in the last few videos. We absolutely murdered that. You can see here in my public account, I closed these for almost 40%. In the public account, I made about $1,400 on these. I bought 7 of them in case you're wondering how many I bought in public. Again, you can see here, signal to the Discord. We closed these on February 21st. I said AMD is having a mental breakdown, up 40%, booking profits here. But I've told you guys this about AMD. AMD is the advanced money destroyer. You definitely do not want to buy calls on AMD. Wait until it confirms for you. In my view, AMD can continue to drop to that $100 level. You see this trend line here that I've showed you time and time again since October 2024, and it just does not want to break out of this trend line. You don't even need the moving averages because it's below every single moving average, including the 500-day moving average. You don't want to buy stocks below the 500-day moving average. That is not buying the dip. That is being a dum-dum. There is a big fair value gap here on AMD between like 98 and 105-ish. That is where I'm waiting AMD to come down to. I shorted it. I took profits because we might see a violent rebound next week in the beginning of the week. But I am net short AMD, or not bullish on AMD until we get to that level, or until it finally breaks out of this trend line and gives us a retest. So you see that right there. If we break out of this and retest it, then I will consider going long on AMD. Until then, do not touch the advanced money destroyer, in my opinion. SMCI, this one is going to be super interesting this week. Why is it going to be interesting? You can see I already have a play set up here. Why is it going to be interesting? Because February 25th is the deadline that SMCI has to deliver its paperwork to the NASDAQ in order not to be delisted. If it is delisted from the NASDAQ, you could say goodbye to SMCI. Hey, that rhymed. It is going to be a pink sheet stock. It is going to be basically like a penny stock. That's not a penny stock, right? You won't be able to buy it regularly. It will be considered an over-the-counter stock. You don't want it there because it will kill its liquidity. So I believe SMCI is going to deliver its paperwork. Obviously, I'm not Nostradamus. Anything can happen. But based on what they said, their last earnings, they said, don't worry, we are going to be delivering it. They are working with BDO, which is a new auditor, a new global accounting firm. They're not a new firm, but it's a new firm for SMCI. And I honestly think there might be a sell the news effect one way or the other. So either they don't deliver the paperwork and we'll know that and SMCI just tanks, or they deliver the paperwork, but this run-up included the enthusiasm of it delivering its paperwork, and we might see more of a pullback. This right here is where I'm targeting calls for SMCI if we get to this level. You can see this was support, resistance, 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 and we gapped here once again. So there's that level between 48 and 51 that I'm anticipating calls for SMCI, hopefully to ride it to eventually that $96 target. This also is going to be beholden to Nvidia earnings. If Nvidia lowers its guidance, then that could mean mayhem for all AI infrastructure companies, including SMCI. But right now, based on its forward earnings, SMCI is actually cheap. This is not just a speculative high beta stock. It is actually cheap based on its forward guidance. You can see here that SMCI's forward PE right now is 20. And lastly, I'm going to be doing a video on bonds, but I do think that bond yields are finally going to drop. Now, I'll tell you why. We formed this head and shoulders here on the 10-year. It looked like we were going to pop above this really important level, which was about 4.5% on the 10-year. You can see here, we popped below it, popped above it, and then popped back below it with vengeance. Now, I think no matter what, the yields finally come down. As I said, this is the first time in history that yields haven't been lower after the Fed cut rates during a cutting cycle 100 days later, right? But there's something in the last Fed meeting minutes that they said. They said that they were likely going to be pausing their balance sheet runoff. So you know that the Fed has a balance sheet. Where is it? And they've been selling or running off securities off their balance sheet because they printed so much money after the pandemic. So it went from 9 trillion all the way down to now 6.7 trillion. However, in their last meeting minutes, they said regarding the potential for significant swings in reserves over coming months related to the debt ceiling dynamics, various participants noted that it may be appropriate to consider pausing or slowing balance sheet runoff until the resolution of this event. So either the Fed, by their own admission, is going to stop running off assets off of the balance sheet, or the job cuts that the government is currently doing, if that affects the unemployment rate negatively, right? If unemployment starts going up, then that means the Fed will likely have to cut. So we are going to get a balance sheet runoff pause, which is the end of quantitative tightening. We also might get more cuts than we expect if unemployment goes up due to the job cuts that the government is currently doing. And because the Treasury said that it is not going to issue more bonds, it's going to keep bond issuance steady for the rest of this year, meaning there isn't going to be an oversupply of bonds. Remember, when there's an oversupply of bonds, that's when yields rally. And because of all those fears I talked about, I do think that we will now finally start to see the long end of the curve, really the 10-year, 20-year, 30-year plus. I think that those yields are going to start coming down, which means that stocks like ETFs like TLT can finally start to have a respectable rally after the Fed cut, which is something that we haven't seen. So if you are someone who is uncertain, you have a lot of short-term positions, or you're considering going cash, I do think that there is a place for bonds here. Obviously, the allocation is up to you. This is not financial advice. Some people will do 60% stocks, 40% bonds. Some people will do 80-20. Really depends on your risk tolerance. Anyway, let me know your thoughts below. Do you think that we are on the cusp of something terrible? Do you think that these are just typical market jitters? Are you bullish for the rest of the year? Are you bearish or neutral for the rest of the year? Are you allocating into bonds, or have you already allocated into bonds? Where do you think Tesla's going for the rest of the year? Do you think Nvidia is going to beat earnings? Hopefully, I tickled your thoughts on a lot of these things and gave you some good information. At the minimum, leave a thumbs up. I would love to hear your answers. Leave a comment down below. Let me know. Sign up if you want access to all of my real-time alerts and trade live with me every single morning at market open. Get yourself a public account, subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.